It was a late evening in New Jersey, the kind where the house is quiet but your mind isn't. Daniel was sitting on his couch, TV on in the background, but he wasn't really watching. His phone was in his hand, scrolling through headlines that all felt slightly different but carried the same tone underneath. Words like recession, market volatility, inflation pressure, rate hikes. Nothing concrete, nothing immediate, but enough to create that familiar feeling in your chest. Not panic, but uncertainty. Daniel wasn't new to this. He remembered 2020 when everything dropped suddenly and people around him started reacting emotionally. Some sold everything out of fear. Some ignored it completely. Some tried to time the market and ended up making things worse. And back then, he didn't really know what to do either. He wasn't heavily invested, but he felt the tension, that sense that something bigger was happening, and he wasn't fully prepared for it. Now, a few years later, his situation was different. He had some investments, a stable job, a bit of savings. On paper, he looked fine. But the question that kept coming back wasn't about what he had, it was about what he should be doing right now. Because when people talk about market crashes, they usually talk about what to do during or after, but almost nobody focuses on what the average person should do before it actually happens. And that's where most mistakes begin. Not during the crash, but before it. Because psychologically, people are wired to react, not prepare. When things are calm, they assume everything will stay that way. When things start shaking, they panic. And in between those two states, there's a window where smart decisions can be made. But most people miss it because nothing feels urgent yet. Daniel felt that window. Not because he knew exactly what would happen, but because he understood something simple. Markets don't crash out of nowhere for the average person. The signs are always there, but they're easy to ignore because life is still moving normally. Paychecks are coming in, bills are being paid, nothing feels broken, and that's exactly why preparation feels unnecessary. He thought back to conversations with friends. Some were saying the market will keep going up. Others were predicting a crash soon, but most people weren't doing anything differently. They were just watching, waiting, scrolling, reacting to news without changing their behavior. And that's the most common mistake, treating information like entertainment instead of a signal to adjust. Daniel realized something that shifted his thinking. He didn't need to predict the crash. He needed to prepare for uncertainty. Because trying to time the market is what gets people into trouble. Waiting for the perfect moment, trying to exit at the top and re-enter at the bottom. It sounds logical, but in reality, it's almost impossible to do consistently. And the average person doesn't fail because they lack intelligence. They fail because they let emotions guide their timing. So instead of asking, when will the market crash, Daniel started asking a different question. If things go wrong, how exposed am I? That question changed everything, because now it wasn't about guessing the future, it was about evaluating the present. He looked at his finances honestly. How much of his money was tied up in investments? How much cash did he actually have available? If his income stopped for a few months, would he be okay? If the market dropped significantly, would he feel forced to sell, or could he stay calm and wait it out? These weren't dramatic questions, but they were real, and most people avoid them because they assume things will continue as they are. But markets don't care about assumptions. They move based on factors outside your control, and the only thing you can control is your position before it happens. Daniel didn't make any sudden moves that night. He didn't sell everything or try to restructure his entire portfolio. What he did was more important. He became aware of his exposure. He understood where he was vulnerable and where he was stable. And that awareness is the first step most people skip. Because when a crash actually happens, it's too late to build discipline. You either have it or you don't. You either prepared when things were calm or you react when things get chaotic. If you're watching this and you've been seeing the same headlines, feeling that same uncertainty but not really doing anything about it, then this is exactly the moment you need to pay attention to. Not because a crash is guaranteed, but because uncertainty is. If you want to understand how to actually position yourself before things go wrong, not just react after, Make sure you like, subscribe, because in the next part, we're going into what the average person should actually start doing right now before the market decides to move. The next morning, Daniel didn't wake up thinking about headlines anymore. He was thinking about his position. That's the shift most people never make. They stay focused on what the market is doing instead of what they should be doing. And the truth is, before a crash, the smartest move isn't reacting to predictions, it's strengthening your foundation. The first thing he looked at was his cash situation, not because cash is exciting, but because it's stability. During good times, people underestimate cash. It feels unproductive compared to investments. But when uncertainty increases, cash becomes power. It gives you time, options, and most importantly, it prevents forced decisions. Daniel realized that if the market dropped and he needed money, he didn't want to be in a position where he had to sell investments at a loss just to cover expenses. That's how most people lose, not because the market drops, but because they're forced to act at the worst time. So instead of chasing returns, he focused on building a buffer, increasing his emergency fund, making sure he had enough to cover several months of living expenses without touching his investments. It didn't feel exciting, but it felt solid. And that's the difference. Preparation rarely feels impressive, but it creates real security. Then he looked at his expenses, not in a dramatic way, not cutting everything out, but understanding his baseline. Because the lower your fixed expenses, the less pressure you feel when things go wrong. Daniel noticed that some of his spending had quietly increased over time. Subscriptions, convenience habits, small lifestyle upgrades that didn't seem significant individually but added up. And in a stable market, that's easy to ignore. But before a potential downturn, reducing unnecessary pressure becomes important. He didn't go extreme. He didn't try to live minimally overnight. He just trimmed what didn't add value. And that alone increased his flexibility. Because now, if his income was affected, or if things became uncertain, he could adjust without panic. And that's the goal, not perfection, but adaptability. The next shift was in how he viewed his investments. Before, he was focused on growth, picking strong assets, watching performance, thinking long-term, but still paying attention to short-term movements. Now he looked at risk differently, not trying to eliminate it, but understanding it. How much of his portfolio was concentrated in one area? How much volatility could he handle emotionally? If the market dropped 30%, would he stay invested or panic? These questions matter more than predictions, because your behavior during a downturn determines your outcome more than the downturn itself. Daniel didn't try to time the market or sell everything. Instead, he adjusted slightly, rebalancing his portfolio, making sure he wasn't overexposed to areas he didn't fully understand, and keeping a portion of his investments in more stable positions. Not because he expected a crash tomorrow, but because he wanted to be prepared if it happened. Another important change was his mindset toward income. Most people focus only on investments when they think about market crashes, but income is just as important, because if your income remains stable, you can ride out market fluctuations without stress. Daniel started thinking about how secure his job actually was, not emotionally, but practically. Could his company be affected by economic downturns? Was his role easily replaceable? These weren't comfortable questions, but they were necessary. He didn't panic or assume the worst. He simply acknowledged the reality that income is not guaranteed. And instead of ignoring that, he started creating options, exploring ways to build additional income streams, even small ones, not because he needed immediate results, but because having more than one source of income reduces dependence, and reduced dependence increases stability. He also changed how he consumed information. Before, he would scroll through news, opinions, predictions, trying to understand what might happen. But he realized that most of that information didn't actually help him make better decisions. It just increased anxiety. So he became more selective, less noise, more focus, because clarity comes from action, not from endless information. At this point, nothing dramatic had happened in the market. Everything still looked normal on the surface, but Daniel was no longer in the same position as before. Not because he predicted anything, but because he prepared for uncertainty. And that's what separates people who survive downturns from those who struggle. Most people wait for confirmation before they act. They wait for the market to drop, until the news becomes serious, until everyone starts reacting. But by then, the best decisions are already behind you. Preparation works only when it happens before it feels necessary. Daniel understood that he couldn't control the market. He couldn't stop a crash or predict exactly when it would happen, but he could control how exposed he was, how flexible he was, how prepared he was to handle it without making emotional decisions. And that's the real goal. Not avoiding losses completely, because that's unrealistic, but avoiding panic, because panic is what turns temporary downturns into permanent damage. If you're watching this and thinking about your own situation, your savings, your expenses, your investments, your income, then you're already ahead of most people, because awareness is the first step and action is what comes next. Make sure you like, subscribe, because in the final part, we're going to break down what actually happens when the market does drop and how the people who prepare differently respond in a way that changes their entire financial future.
A few months later, nothing looked dramatically different on the surface. People were still going to work, markets were still moving, news cycles were still full of mixed opinions. But underneath that normal routine, tensions started building. Small drops in the market became more frequent. Headlines became slightly more serious. Conversations shifted from confidence to caution. And this is usually how it begins, not with a crash, but with a slow change in sentiment. Daniel noticed it, but this time his reaction was different. In the past, even small drops would have made him uneasy. He would check his portfolio more often, question his decisions, think about whether he should sell before things got worse. But now, there was no urgency, not because he didn't care, but because he had already done the work before this moment. This is where preparation starts to show its real value, not when everything is stable, but when things begin to move. Because most people don't struggle with understanding what's happening, they struggle with how they feel about it, and feelings drive decisions. As the market dipped further, Daniel saw something interesting. The people around him started reacting emotionally. Some of his coworkers were talking about pulling money out to protect what's left. Others were glued to their phones, watching every movement like it was a signal to act. And a few were completely ignoring it, pretending nothing was happening. Different reactions, but all driven by the same thing: uncertainty. Daniel didn't feel the need to react immediately, because he wasn't in a position where he had to. His expenses were under control, his emergency fund was in place, his investments were structured in a way he understood, and most importantly, his expectations were realistic. He knew markets go down, not sometimes, but regularly, and that understanding removed the shock. This is the difference most people miss. A market drop doesn't hurt the prepared investor the same way it hurts the unprepared one. Not because the numbers are different, but because the pressure is different. When you're overexposed, every drop feels like a threat. When you're prepared, it feels like a phase. As things continued to decline, Daniel didn't start selling. He didn't try to time the bottom. He didn't make sudden decisions. Instead, he followed what he had already planned. He kept his investments consistent. In fact, he continued investing regularly, even as prices dropped. And this is one of the hardest things to do psychologically, buying when everything feels uncertain. But this is where long-term thinking actually matters. Because when markets fall, prices become more attractive, but fear makes them look dangerous. And most people don't take advantage of that because their emotions override their logic. Daniel didn't feel fearless. That's important. He still felt the discomfort, but he didn't let that discomfort control his actions. At the same time, his cash position gave him confidence. Knowing that he didn't need to sell anything to survive allowed him to stay patient. And patience is what most people lose during downturns, not because they don't understand it, but because they can't afford it. He also saw something else clearly during this phase, how fragile most people's financial situations actually were, not because they were irresponsible, but because they were unprepared. High expenses, low savings, heavy reliance on income, and investments that were made without understanding risk. When everything is going up, these weaknesses are hidden, but when things start going down, they become visible. Daniel wasn't perfect. His portfolio still went down. He still saw losses on paper. But the difference was, those losses didn't force him into action. They didn't change his behavior. And that's the key. Because in investing, what you do during downturns matters more than what you do during growth. He also became less focused on short-term outcomes. Checking his portfolio daily didn't make sense anymore. It didn't change anything, so he reduced that habit. Not ignoring reality, but avoiding unnecessary stress, because constant exposure to negative movements can distort your thinking. Instead, he focused on what he could control: his income, his expenses, his consistency, and that focus created stability even when the market didn't feel stable. This is where the real advantage of preparation shows up. It's not about avoiding downturns, it's about navigating them without damaging your long-term position, because markets recover over time, but bad decisions during downturns can have lasting effects. Daniel also noticed a shift in how he viewed opportunity. While others were focused on protecting what they had, he started seeing potential in what was happening. Not in a reckless way, not trying to guess the bottom, but understanding that downturns are part of the cycle that creates future growth. And being in a position to participate in that, instead of being forced out, is what makes the difference. He didn't feel like a genius. He didn't feel like he had everything figured out, but he felt stable. And stability during uncertainty is one of the most valuable positions you can be in. If you're watching this and thinking about how you would react if your investments dropped, if your income became uncertain, if the market didn't behave the way you expected, then this is exactly why preparation matters. Not because you can predict the future, but because you can handle it when it arrives. Make sure you like, subscribe, and join Andrew Finance, because in the final part, we're going to bring everything together and show what separates the people who come out stronger after a crash from those who spend years trying to recover.
When the market finally dropped hard, it didn't feel like a movie moment. There was no single dramatic day where everything collapsed at once. It was a continuation of what had already started, just faster, sharper, and more emotional. Headlines became louder, people became more reactive, and suddenly what was once just a possibility turned into something real. Daniel woke up one morning, checked his phone, and saw his portfolio down more than he had ever seen before. Numbers that used to be green were now deep red. And for a moment, there was that natural reaction, the one everyone feels, a slight tension in the chest, a thought that says, should I do something? But then something different happened. He didn't act, not because he was ignoring it, not because he didn't care, but because he had already decided how he would respond long before this moment arrived. And that's the difference most people don't understand. You don't build discipline during a crash. You rely on the discipline you built before it. Around him, everything looked different. Coworkers were talking about pulling money out, friends were messaging each other, sharing news, asking if it was time to sell. Some people had already exited the market, trying to stop the bleeding. Others were frozen, not knowing what to do. And a few were pretending it wasn't happening at all. But most of them had one thing in common. They were reacting in real time, without a plan. Daniel wasn't immune to fear. That's important. He still felt it. But his situation didn't force him to act on it. His expenses were covered. His emergency fund was intact. His income, while not guaranteed forever, was still stable for now. And because of that, he had something most people didn't in that moment: time.
Time to think. Time to wait. Time to let the market do what it always does, move through cycles. Instead of selling, he stayed consistent. He continued investing even as the market dropped further. And this is the part that sounds simple but feels incredibly difficult when you're actually in it. Putting money into something that is actively losing value feels wrong. It feels like you're making a mistake. But in reality, this is where long-term gains are built. Because when prices fall, your money buys more. Not immediately rewarding, but powerful over time. Daniel didn't try to guess when the market would recover. He didn't wait for the perfect moment to invest. He stuck to what he had already planned, and that consistency removed the need to constantly think, react, and second-guess. At the same time, something else became clear. The people who were struggling the most weren't necessarily the ones who lost the most money on paper. They were the ones who were unprepared, the ones who had high expenses, little savings, and no flexibility. For them, the market drop wasn't just a financial event, it was a pressure point that affected their entire life. Some had to sell investments at a loss just to cover basic expenses. Some stopped investing completely out of fear. Some made impulsive decisions trying to recover quickly, only to make things worse. And that's how downturns create long-term damage, not through the drop itself, but through the reactions it forces. Daniel avoided that, not because he was smarter, but because he had positioned himself differently before it happened. Months passed, and slowly the market began stabilizing. Not a sudden recovery, but a gradual shift. The same way it dropped, it started moving back up. And this is where the final difference shows. Because the people who sold early were now watching from the outside, waiting for the right time to get back in. The people who panicked were still recovering emotionally, hesitant to trust the market again. And the people who stayed consistent, who didn't let fear control their actions, were already positioned for the recovery. Daniel saw his portfolio start to climb again, slowly at first, then more noticeably. And the investments he made during the downturn, the ones that felt uncomfortable at the time, started showing the strongest growth. Not because he timed anything perfectly, but because he stayed in the game. And that's the real outcome of preparation. It doesn't just protect you during a crash, it positions you to benefit after it. Looking back, the most important thing Daniel did wasn't predicting the crash. It wasn't making perfect investment decisions. It was controlling what he could control before everything became uncertain. His expenses, his savings, his mindset, his expectations. Because once uncertainty arrives, your options become limited. But before it arrives, you have control. And that's the window most people waste. The truth is, the average person doesn't need to outsmart the market. They don't need to predict economic cycles or find the perfect investments. They need to be prepared enough to not break when things go wrong. Because markets will crash again, not once, but multiple times throughout your life. And every time, the same pattern will repeat. Fear, panic, reaction. And every time, the people who prepared will move differently from those who didn't. So, if there's one thing to take from this, it's this. Don't wait for the crash to decide what kind of investor you are. Decide it before. Build your position when things feel normal. Create space in your finances. Understand your risk. Strengthen your mindset. Because when everything changes, it's too late to start. If this changed the way you think about market crashes and preparation, make sure you like, subscribe, and join Andrew Finance. Because here, we don't just talk about making money, we talk about keeping it, protecting it, and positioning yourself to win, even when things don't go your way.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.